The largest and most profitable retail banks in the world in 10 years will all be digital banks.
In this current environment where funding is very hard to come, you announced a significant raise.
Yes, we raised 250 million with a new bank as the lead investor in our Series B in a raise that puts our enterprise value at 1.5 billion.
IT is something you could buy or sell. The rest takes time. In South Africa, which has nearly 20% of the customer base. How do you see them as competitors in the future?
Technology is the least of your problems. This is essentially a pervasive business culture, strategy, and operating model problem that has to be addressed at the root. I would say that the difference between an AI-empowered and an AI-native bank and one that is not, it will not be 20 or 30% better, it will be 10x.
Hello, everybody, and welcome back to Season 4 of Couchonomics with Arjun. Joining me today virtually is Couenraad Jonker, who is founder and Group CEO of Tyme. Coen, I guess welcome to the show.
Thank you, Arjun. Great to be.
Right. Well, I wouldn't say I'm new to Tyme because I had the opportunity of Nate joining me on the couch when I was at Singapore FinTech Festival last year. So I know a little bit about what he's up to in Philippines, but hopefully we can get the whole perspective, right? So let me dive straight in, right? Give us a little bit of a background on Tyme as a group and, number of banks that you have as an overview to the listeners.
We're a digital banking group, multi-country, focused on consumers and small and micro business. We're headquartered in Singapore. We have banks in South Africa and the Philippines and operations in Vietnam and Indonesia as well. We're about 6 years old. We launched in February 2019 in South Africa. We now have 11 million customers in South Africa. We launched 2 years back in the Philippines. We now have 6 million customers in the Philippines. So 17 million customers across the two markets. And somewhere around 100,000 small and micro businesses on the platform as well.
Excellent. Right. So before we get into and talk a little bit more about Tyme, let's take a step back, right? Because I'm sure the listeners want to hear. Last 10 years, we've seen, I guess, digital banking grow. There's statistics out there where they say the number of customers using it has doubled. I don't know, someone said nearly 1.7 billion customers are using it, right? So from your perspective, both from the markets that you operate in and just generally, what have you seen? What are the shifts that you've seen which has led to this rapid expansion?
Technology, customer behavior, and regulation. That's the sort of perfect combination of factors in an area like digital banking, and it's sort of come together perfectly. Sometimes when we talk about our business, we can list all the unlucky things that's happened to us in the last 6 years. COVID and a few other things. But fundamentally, the winds of history are behind us in all three of these areas: technology, customer behavior, and regulation. And we are, I would say, in the first half of this change. We have not even seen, I think, the most profound impacts that the combination of these things will bring about, particularly in retail banking.
No, so interesting. So let me give you a counter challenge on that, right? I buy into the whole consumer angle. I think regulation is definitely being more enabling, and let's not even talk about technology because every minute of the day we act it. Having said that, vast majority of the digital banks are failing or have failed or are struggling, right? So let me ask you a reverse question. What is the recipe for a disaster that a number of digital banks have repeated over the last decade?
I guess to think about any of these new technology trends, it is a bit like a gold rush, and we all know about the sort of a Gartner hype curve. Is there's a moment in history where this opportunity is obvious to everyone, and everyone dives in. But just like a gold rush, and like new business in general, you have this trend that a lot of people fail initially. Um, Partly people fail because it's all new. When I speak to potential partners in a new country that we enter, I say to them, my proposition to you is very simple. I'm not coming here to learn to shave on your face because I've already built a number of digital banks. And so I think there has been and continues to be a lot of hard lessons learned in how to do banking in a new way. Um, and a lot of money wasted in the process of learning these lessons. At the same time, I think the recipes for success are becoming clearer. And so uh, I think that what we will see is that the number of players in the market that can be successful will increase. Now, one factor that I think people sometimes do not appreciate about digital banking that has contributed to the high failure rate is that digital banking is a scale game, and the economics of digital banking are very similar to the economics of any platform play, which is initially you have to spend a lot of money, you have to build a robust platform, and uh, then you're in a race against the clock to get enough scale on that platform to justify that initial investment. Now, once you through that break-even point, you can become spectacularly profitable. And the likes of Nubank and Revolut and our operations in South Africa are starting to prove exactly how profitable these things can become. But you have to get to that critical mass. Um, and so I think maybe a lot of the initial investors in digital banking were people who came into the industry used to investing in garden variety B2B fintechs, or people who used to invest in traditional banks. And this is a new set of, I would say, business and operating model dynamics that we only fully understand now that we sort of, I would say, through that initial hype curve in this new industry.
No, interesting you say that. I will come back to this question because we had a discussion about 2 years ago. I think it was in Singapore where we said, does digital banking need more patient capital compared to, I guess, if I may use the word, traditional fintech, even if that doesn't make sense, right? I'll come to that. I'll also come back to the other question. So I agree. You said build a platform, I guess, scale up the customer base, and then build some product density, right? But let's deconstruct that for a bit from your perspective, right? You have, I think, 11 million customers in South Africa, 6 million. These are sizable numbers, right? And I'm assuming Philippines have 100 million people, and South Africa's population 65. So that's sizable penetration, right? So what's been the secret sauce here?
So for us, I would say our party trick, our key to success has been operating in the Phygital space, and particularly building businesses that cross over into physical retail environment, offline retail environments, and integrates into the customer's shopping experience. So what we have, for those who don't know the Tyme model, what we have out there is we actually deploy a digital kiosks. They're sort of a stand-up device that looks a bit like a ATM, and you can think of that device as a vending machine for a credit card or a debit card. So a customer can walk up to it in a self-service way, often assisted by a brand agent or sales agent. They can sign up for a bank account in 3 to 5 minutes, get a debit card printed and distributed to them, and then they can walk over to the checkout counter inside the retail store to deposit their first cash into that account. And they immediately also live on the loyalty program of the retailer. And so that sort of experience embedding banking into the physical shopping experience has been a major differentiator for us. And added to that, the use of the data inside that retail environment, the leveraging of the brand of the retailer, all of those things have contributed significantly to two things. Number one, our pace of customer acquisition. The second is our low cost of customer acquisition. So we think that outside of China, we've got the lowest CAC, customer acquisition cost in the world. And a bit counterintuitively, because you think, well, surely online should be cheaper. Online's not cheaper. This is the cheapest way to get a customer. And I would say if there's any one thing to emphasize in our success so far, it has been the use of this channel.
No, I love it. Right. So Phygital is the new digital, right? Let me probe that a little bit deeper, right? So analysts have suggested, I'm personally convinced, and you're actually proving that physical contact is essential, especially targeting the underbanked, the financially excluded or semi-excluded customer base, whether it's individuals or small businesses, right? And you just reiterated it in terms of how important it is from your matter. Taking a bit of a theoretical approach, right? What are the success metrics beyond CAC that you look at, which allows you to sort of strike the balance in terms of, do we need to double down more phygital, or we need to up our digital game, specifically as the customers mature in their relationship with you?
Yeah, that's a very interesting and rich part of our learning, is to understand how the channel in which I acquire the customer and the way I acquire customer, how that predicts the customer's behavior from that point on. And I would say there are two sort of areas of data that are very useful to us. The one area is the sort of, let's call it adoption, customer revenue data. The other is the customer experience data. In other words, what is our net promoter score? How are we doing with the customer relative to the customer's initial expectation of what they would get with us? And I would characterize it broadly as our customers that come to us in a pure online way by downloading the app and not visiting the store are our better customers. They tend to be our more sophisticated customers, and they tend to be the customers that over time we make more money from. But they're the minority of our customers. So our business would be a lot smaller if those were the only customers we have. So that's the one part of the equation. On the customer experience side, as a general trend, what we see is that the customers who do engage with us in the physical environment are generally either less demanding or generally just happier with us. And I think part of that is the fact that this customer actually now has a local store, my local retailer, where somebody from my community is in that store representing the brand. And when something goes wrong, I can walk into the store, I can ask a question, I can replace my card, reset my PIN, understand what's going wrong, deposit and withdraw my cash. And I have a certain level of trust in the brand because it tends to be associated with my trusted local retailer and their loyalty program. So these are trade-offs. I think that in future we will see directionally more and more of our customers being purely app download online customers. But I don't think that one should conclude from that the Phygital channel will become irrelevant, because I think as a trust building channel, as a backup channel, and as a channel to facilitate that transition from cash and old school banking into the new world, it is a uniquely successful channel.
No, it's fascinating because, you know, I sometimes wonder why so many telcos have unsuccessfully launched banks, right? When they have had that physical presence, they've had that availability at the last mile. Some can argue that it's a trustworthy brand because you use it for your phone connections. They're hyper localized, especially in continents like Africa. Yes, we've seen success with the Airtel monies, M-Pesa, but not as they expand into banking, right? The mobile money, tick in the box. As they get into sort of banking products, the jury's out. Well, most majority of them. In any case, let's move on. Firstly, I should have congratulated you when we started the call. In this current environment where funding is very hard to come, I think a month or so ago, or maybe a couple of months ago, you announced a significant raise.
Yes, we raised 250 million with a new bank as the lead investor in our Series B, in a raise that puts our enterprise value at 1.5 billion. So we're relieved we got it done before the trade war madness descended on us. So for once,
Well done.
we got our timing right, and it's done. The money's in the bank, and we pretty much now can just focus on execution.
So how do you plan to deploy it? And how do you continue to build this moat, right? I know Phygital is the story today. I'm sure Phygital will be part of the story tomorrow. Without asking for all your secrets, how do you plan to deploy it? Are you planning to enter new countries, double down where you are?
So I would say that the first priority has to be in a time like this to make sure that we already operate, we do a great job. And so a lot of our effort is going into South Africa and the Philippines, making sure that we deepen our penetration, that we continue to invest very heavily in the customer experience. We're going to put money in the repositioning of our brand in South Africa to be more of a aspirational brand in terms of the brand positioning. So I would say job number one is make sure we're very successful where we are. Job number two is making sure that our underlying technology platform and our operating model is well suited to a multi-country expansion, and that we invest heavily into what we think is the true moat for the future. So if you ask me what do I think is the true moat, the true moat is being able to go faster at lower cost with better quality results in the customer experience space. So in anything that we build and roll out in the customer experience space. Yes, banking licenses are actually very powerful. It's a very powerful structural advantage to be a business like us who have a banking license, have both sides of the balance sheet, are able to take cheap deposits and deploy it into lending. I mean, that is truly a license to print money once you're at a certain scale. But we don't think that banking license itself is a sufficient moat. We think it is the fitness of the cybernetic organism, which is the business, that will be the competitive advantage over the long term, both against incumbents and new players. And so getting that right, I think, is at the heart of success. And then the next job, the number three job, is expanding into new countries. Now, we've seen the best banks in the world take two approaches. I would characterize it as the new and the Revolut approach. New goes very deep into fewer countries. Revolut takes a narrower proposition and goes harder into more countries. I would say we are more in the new space than in the Revolut space. We think that over time, the bulk of economic value that gets generated in banking will still get generated by the top 3 to 5 players in the market, and therefore there's more value in being a full service retail bank at scale in fewer markets than being a small player or a niche player in many markets. I think there are arguments both ways, but that's certainly the strategy that we'll be emphasizing.
And that's quite interesting. Uh, I'm sorry, I'm not going to put words in your mouth, but let me play this back in the way I say it. See it. So what you're saying is, we took a digital first approach to enter the market, right? We then went phygital because we realized that it drives down our CAC, improves our experience, builds our trust, right? We want to go deeper, in my words, in terms of product density, share of wallet, and that might evolve us into a full service bank where digital becomes part of the DNA, but doesn't necessarily dictate everything we do. Am I correct?
That's a good summary. The way we think about digital is a means to an end.
Right. And I agree.
So to put the technology or the mode of technology at the center, we think is the wrong approach. The right approach is to say, how will customers consume these services in future? And how will we deliver that to those to customers in a way that is truly differentiated from the customer's perspective, where and the way to know that it is that our net promoter score is significantly better than that of the competitors. And how do we do it in a way over time that escapes the commoditization of banking? Because I think that this is something that we will see, is that the barriers to entry in many respects in the fintech world are coming down. It's not that difficult to replicate experiences. And the question is really, what will be the factors that will over time allow players like us to escape commoditization? And we think that it will be largely in this platform space, in the ability to create a set of customer experience that have unique value, not only to the individual customer, but also to their connection into their business and personal communities.
So a couple of questions, challenges. I'm a management consultant. That's what I do for a living. I do a lot of work with regulators, right? One of the questions which keeps coming up in multiple jurisdictions is, are digital banks fintechs? Are they banks? If they're banks, should we regulate them more as banks? And why should we have a special set of regulations for digital banks? Because why are we forcing them into an operating model when they can actually meet the wider need of the nation by being more than digital banks, right? You also then have the other cohort, which are the investors, right, who have philosophies which say, we want to invest in digital banks and fintechs. We don't want to go after traditional FIs, while the traditional FIs can be very profitable, right? And especially if they're able to use technology exactly the way you said it. So where do you see this debate heading, right? Are digital banks just banks? Right? And should we not treat them like B2C, BNPL players or crowdfunding platforms? And do you think the investors will understand the nuance?
Arjun, we grapple with this all the time.
I could imagine.
And the first thing I will say is that actually this debate does matter. I hear sometimes people going, it doesn't matter, like whatever you call it, it really does matter, because as humans, we make meaning of categories through categories when it comes to highly abstract things like fintechs, digital banks, and so on. It matters to investors because they try to figure out, what is my heuristic? How do I see this thing? How do I measure whether this is a good thing? It matters to regulators. It should matter to customers, because I think there's a very big difference between getting a service from an unregulated or very lightly regulated fintech than it's different from getting a service from a bank, and understanding that difference in terms of trust and so on is important. So what do I think about digital banks? I really do think that increasingly it is its own thing. It is neither a traditional bank nor a garden variety fintech. And making it its own thing is useful from a number of perspectives. The first thing is that that it is useful from a investor's perspective, because it allows the investor to understand what they're investing in and to understand what good looks like. And what I predict is that the largest and the most profitable retail banks in the world in 10 years will all be digital banks. And they will have returns on equity that are in the order of magnitude of twice as good as traditional banks. So where a traditional bank is styling in an emerging market in a return of equity of between 12 and 15%, digital banks should have returns of equity in the region of 35 to 45%. And the reason is not that they have digital channels. The reason is that it's a fundamentally different business and operating model with different economics. But at the same time, digital banks are very capital intensive. They have that in common with banks. And therefore, the same people who are investing in payment platforms or in B2B cybersecurity solutions, they cannot invest in digital banks with the same mindset. It's important to understand the capital intensity, the regulatory limitations, et cetera, that apply to digital banks that don't apply to many other fintechs. So I think that that's the investor perspective. The other perspective is the regulator's perspective. Now, we operate in one market where we operate with a full commercial banking license, and in another market where we have a digital banking license. Now, I think that over time, there's not that much in these, as the market matures, there's not much in these initial regulatory differences. However, I think that in this phase, as the world goes through this transition into digital banking, regulators who care about financial inclusion should consider customized regulation. And simply for two reasons. Number one is to reduce the barriers to entry for new players into the market. The second is to allow regulators to actually focus on the particular new set of risks and opportunities that sits within this new business and operating model category. I think that, in 10 years, it probably won't matter. You'd probably be able, once digital banks have scale and so on, you're probably able to run them under exactly the same regulations that you run a current retail bank, and you could combine those regulations in one. But if you don't have these unique digital regulations, what you tend to do is you tend to create a set of expectations for digital banks that just don't work for them. They're markets where they've got whole teams of people who want to come in and see your branch. We're in a smaller license application process now, where we've had to put cameras into our office just because there's a tick somewhere in the box that says you have to have CCTV somewhere in order to meet some regulatory tick. It makes no practical sense to do that, but these are the kinds of banal examples of where old regulations just don't fit the new boxes.
Okay, then fair enough. So, I think most of the progressive regulators do appreciate that, even they might not have got it right. But I think the direction of travel is in the right direction, right? But let me come back to the question when you said in 10 years' time, the leading retail banks are all going to be digital banks, right? I'm hoping some of those incumbents who exist today, who are huge, are going to be part of the mix, right? Okay. Now, here's the question, and I would really, really welcome an outside-in perspective, right? Commentators are very quick at pointing out legacy IT infrastructure as being a big challenge, right? I usually counter that by saying, IT aside, culture, personnel, decision making, the nature of the shareholder equation, right? Those actually are much more systemic and prevalent, right? IT is something you could buy or sell, right? The rest takes time. How do you see the incumbents responding to, you know, banks like yours in South Africa, which has nearly 20% of the customer base, right? Sooner or later, you're going to start taking a heavy chunk of the profitable customer base, if you haven't already. How do you see them as competitors in the future? How do you see this all kind of unravel?
And maybe unravel is the right word. Um, I've had two stints in my career working in traditional banks. I was the founding director of the inclusive banking division in Standard Bank in South Africa in 2005. Then I served for a few years on the executive committee of Commonwealth Bank of Australia. Uh, and so I've seen the world from that perspective. Now, the first thing I will say, I'm with you 100%. Technology is the least of your problems. This is essentially a pervasive business culture, strategy, and operating model problem that has to be addressed at the root of 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 what the DNA of the business really is. And what I would say is that if you look at the DNA of the best digital banks in the world today, it's a fundamentally different DNA, different personality types, different priorities, different way of thinking, different way of accounting. You know, I can bore you to tears for the rest of this conversation just talking about how capital accounting affects the success of digital transformation in a business. These things all combine, they all add up to a business that is where um, uh, the clock speed of the business, the cybernetic organism's whole um, uh, flow and nature is fundamentally different. And I think until the captains of of the big ships out there, until the day that they truly appreciate the extent of uh, uh, genetic deviation that we now see between these two organisms, they will not successfully transform those businesses. Um, and even when they get to the point where they maybe fully understand how different these two kinds of businesses are, what it will require is it will require very high conviction to go out there and create this the new piece of this business that will over time sort of supplant or overtake the traditional business. Um, yeah, I don't know whether I'm being very eloquent in describing this. We can go into a lot of detail, but I think one of the reasons we all struggle to get our heads around it is that it is a death by a thousand cuts. There's not like one or two neat ways to say this is how this business is different. It's different in hundreds of meaningful ways and in subtle ways that are not that obvious in the headline of how the business is structured.
Let's simplify this, right? as you said, death by a thousand cuts, lots and lots of nuances. So let's stop launching digital attackers. Why not go acquire? And do you see that shift coming along? Because we haven't really seen, if I may say, hyperactivity in that space, right? Most large banks are still dismissive. They're like, fine, they're digital banks. They're targeting the financially excluded, lower income segment. We're on the up on the experience curve. You want the affluent customer, the share wallet, the fee-based incomes. Something's got to give, right?
Yes. So, to be clear, I do think that banking is a lot bigger than consumer banking and then small and micro business banking. And a lot of what matters in banking in the world actually sits in the investment banking, corporate banking, private banking, all of those spaces. And those are spaces that, from where I sit, looks a lot less problematic or a lot less likely to be disrupted, certainly sort of in the timeline that we're talking about here. Um, uh, the problem with acquisition, and I think that there will be acquisitions in the future and so on, is the risk of a reverse alchemy, which is that you take gold and you turn it into lead, um, um, and that happens very easily because
It's happened quite
you
often.
you and because it depends on who you empower in the business and whether the people who are now the bosses of the people who have been acquired actually understand what matters within that business and how to run that business in a way that continues to create value. And banking is particularly difficult because of risk regulation and governance requirements. And so um, it it's even for a digital bank, a licensed digital bank, it is hellishly difficult to continue to innovate within the constraints of the regulatory environments in which we operate. Even more so if you then overlay, all the other traditional aspects of banking, and you want to you want to operate the bank within that environment. So can acquisitions be successful? Yes, but only to the extent that you get the governance right and that you empower the right people once you've done the acquisition to not create a suboptimal trade-off of priorities and interests within the digital piece of the business.
No, I agree with you. But here's my 2 cents worth. I do appreciate that corporate banking, investment banking, capital markets is arguably less disrupted. But, we're seeing the growth of wealth tech, right? And it's not just robo-advisory, but intelligent asset management. We're seeing transaction banking being disrupted. You're already disrupting the medium and small businesses. There's nothing stopping you then going into the corporate space. You got CBDC stable coins, which is impacting cross-border movement of B2B money, which is very profitable for banks currently. That's being impacted. So I think there's a tsunami of changes. Maybe it's a bit further out in the ocean right now. And then, with what Coinbase just announced about well, they didn't announce or potentially suggested that rather than doing an IPO, they'll basically issue tokens. The entire IPO world sort of changes and everything connected to it too. Right. So I do think something will have to give, because here's the question, right? All these new technologies just accelerates and when I say yours, the digital banks, to move faster and actually the chasm becomes wider in terms of the experiences, the products, and the solutions that can be offered, right? Because, as you said,
Yes.
your DNA, your operating model, your cybernetics is more attuned to this, right? So the question here: how do you look at emerging technologies as a business?
With a combination of like heightened anxiety and excitement. I feel personally, very challenged by the pace at which all of this is coming at us. I had a interesting sort of 4 year period where I decided I need to get my fingers off the keyboards. So I gave back my laptop and just kept my iPad and my phone for 4 years, saying, because I frustrate my colleagues when I tinker with their spreadsheets and so on. I've just gone out and bought myself a state of the art a new MacBook. And the reason is that I don't think that even as the group CEO, I can afford not to have my fingers on the keyboards. The extent to which technology has become closer to the user, and the user can start actually developing their own tools through things like low code and no code solutions and so on. Um, that has created a world where suddenly technology is not something for the 600 engineers we have in Ho Chi Minh City. It's something that actually puts demands on all of us and will fundamentally change our productivity. So the way we think about it now is that, and I'm sorry to be boring and say AI because it is, I think that is the outstandingly the most transformative technology in our industry today. I would say that the difference between an AI empowered and an AI native a bank and one that is not, it will not be 20 or 30% better. It will be 10x. I say to my colleagues, we're very proud that we're running a retail bank in South Africa with, where the retail bank side has 350 employees. I can see that it's now possible to run that same bank with 30 employees. Um, so, um, so the extent to which our ability to adopt new technology will affect our success is that is increasing, and um, uh, what we're grappling with is how do we inject that in everything we do, how we recruit, how we train people, what we emphasize, and so on in engagements even in the operating model, how we sort of empower people. We think increasingly there are so many different technology tools out there that differ so vastly between different domains that actually we need to reorganize our entire business into specialized domains and empower every domain to pick its own tools. Now imagine a procurement environment where big banks take 6 to 12 months to decide to onboard a new merchant, a new supplier. And then you have to go through multiple layers of security and due diligence and so on before that supplier can be used. And then that supplier has to find its way inside these very strict walls, these cybersecurity walls. In the time where a fintech maybe tests 5 different tools, kicks out 4, becomes good at using one, and increases its productivity by a significant percentage, the big bank is still, in a risk committee figuring out which one of the 7 they're going to even allow in the door. So the thing we're grappling with is that our very operating model and the clock speed of everything in our business, including legal, procurement, recruitment, and all these things, are going to have to change, are going to have to adopt. And it's embarrassing to say because we're only 6 years old. We have legacy mindsets to address in our business. We have to change the way we do business. And if that's true for us, I know that it's doubly true for our colleagues in big banks.
Well, it's 10x true. Then, no, here's a thought which I'm going to share with you. Right, a lot of the large banks have built what I call trust through fear. Right, and we don't need to divulge into it. People would know what I'm talking about. With the emergence of agents and us as customers in the future having agents which can replace or represent us better, I think that fear quotient within decision making on your choice of financial products either lessens or completely diminishes, right?
Mm.
And to me, that's the last bastion to fall, right? Because if that trust by fear goes down, you could see a seismic shift in the way we interact with our banks. In any case, that's my thought. I know we're short of time, but I do have to ask you one question before we end it. Ecosystems. You have mastered the art of working with third parties. A lot of people have tried that in the past. I myself come from a background where I tried to build a fintech which was based on ecosystem relationships because I used to work for a large retailer, right? How do you go about selecting them? Forget about how you manage them. How do you actually go about selecting them?
There's no doubt that ecosystems are the way to go, and that the future of finance is contextual and embedded. That people don't want to go to a branch to do their banking. They want the solutions to be there when they need it within their context, and therefore, partnerships are not a luxury. I think they will be part of our lives. We've learned hard lessons in this over many years. Even before we started the business, this has always been the mindset of the team. And I would say that what we're learning is, number one, find partners that are technologically and culturally compatible. Where, if and to the extent that you need to put technology together, that there's a level of compatibility, you're in the same generation, and that culturally you are compatible. Try and find partners that themselves understand partnership and have a good reputation as being able to partner, that don't have a culture of sort of we are the big player and we're not willing to sort of take advice or thoughts from anyone else. And then understand the industry dynamics. So we've learned that, interestingly, we can partner very well with retailers. We get along well with them. We partner very well with technologically empowered other financial services players who have similar sort of technology approaches. We have failed with mobile operators. And I was very tempted to jump in and comment on why I think mobile operators have not been successful in banking. But one of the reasons is that mobile operators are, by their very nature, they are giants, and they used to dominate the environment. And so we haven't had good luck with mobile operators trying to partner with them. And we haven't had good luck with non-business players. We've tried things with, for instance, churches. And we've learned that there's a certain level of commercial compatibility required to partner well. And so I think a lot of lessons to be learned. But then the last thing I'll say is developing your own DNA to be a good partner, learning the humility that is needed in partnership, and not having an attitude of I want to take the whole cake and eat it. Being willing to divide up that cake fairly and in a sustainable way. Those are all very important aspects in getting it right.
Yeah, I think those are very good lessons to learn with. Coen, you've shared a lot about what your vision is going forward. I'm going to ask a question. You can choose not to respond. Are we going to see Tyme in some form or shape in the MENA region in the foreseeable future?
Our immediate priority is Southeast Asia. I do think that Africa is very interesting in the medium term. I think North Africa and Middle East very interesting, even faster than that. So we're always open to conversations, but we've got our hands full right now in Southeast Asia, and as you know, it's an exciting part of the world.
Oh, it's terribly exciting. Terribly exciting.
So I'd say medium term the answer is yes, but not immediate.
Kun, thank you. Appreciate you taking out time. I assume you're tuning in from Singapore or South Africa?
Singapore today.
Singapore today. Well, if you ever make it down to the Middle East, right, it'd be a pleasure to meet in person, or I'm sure our paths will cross in the coming few months in some of those events. Thank you again, and wishing you and the group the very best.
Thank you.
Thank you.